You are listening to Keystone Stock Talk Podcast, episode 139. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We have a busy show planned for you this week. In our Case For, Case Against segment, we have a look at retail, e-retail, and cloud computing services giant Amazon Inc., symbol AMZN on the NASDAQ. Aaron argues the bear case. I crush him with the bull case. And Uncle Brennan sits in as judge, jury, and executioner. In our Your Stock Our Take segment, we answer a listener question on the very topical Enthusiast Gaming Holdings Inc., symbol EGLX on the TSX. The principal business activities are comprised of media and content, entertainment, and eSports. The stock has had a tremendous run and is growing at a high clip via acquisition. In terms of revenue, we look at whether it is sustainable going forward. I'd like to welcome my co-hosts, Brennan and Aaron. How are you guys doing?
Doing well. Salutations.
Doing good. We heard your talk on the radio with Michael Campbell on Money Talks.
Yes, yeah, I know it's always great to be on. Enlightening, did you say? Enlightening?
Very enlightening, yes.
I thought you just said lightning for a second there, and I said I thought it was actually longer than usual, but no, it was good. It was a good segment. Mike's always a good interview. The audience is great there. He started off by talking about my last appearance, which was actually October 31st, Halloween, spooky appearance. And the three stocks I recommended then was ProTech, Polaris, and Acme. ProTech was up 35.5%. Polaris was up 58%. Acme was up 31%. So that's always a good start. When the last time you were on the show, all three stocks were up. The average gain was 42%. So it was always good to come on and talk about that. We talked about that briefly. And then the markets generally, the valuations. I talked about, how we look at the market from a broad perspective using the Shiller PE. I said it was at 36 right now. 36 is 40.5% higher than the recent 20-year average of 25.6. So, and really the recent 20-year high is 36. So we're at the high right now. And what does that mean in the market? What does that mean? What should we be doing? Should we be going out there essentially and selling everything we own, sell all the stocks we own and run for the hills? Well, I said that it kind of means more that the markets aren't cheap broadly and you need to be aware of what you're buying and the valuations. But we also talked about how stocks are still attractive relative to, say, bonds and many other investments out there. But it does mean that not all stocks are cheap. I need to know what you are buying and what you're owning, not just the price, but the value you are getting in that underlying investment in that stock that you own. So we went through all of those things too, and talked about a couple individual stocks as well.
Yeah, it was good.
And one thing that I'm excited about with the DIYs is that, when you're on the radio show, for example, you have 20 minutes, if even that, to basically, explain, talk about as many things as you can that are going to give people good tools to manage their own investments, and then provide a couple of companies, talk about your past picks. With the DIYs, we have, 3 hours to really talk about this stuff and dive deep in. So just on the topic of valuation, you talked about the Shiller PE, cyclically adjusted price to earnings ratio of the market, and where that is relative to other points in time in history. We want to go even deeper. There's other valuation metrics that are based more on bond yields and interest rates that we also want to take a look at, see what they're saying, but then also, more than just providing a lot of data about whether or not how expensive the market is or isn't, but really giving people actionable advice on what to do with that information and how to how to manage their portfolios going forward. And another thing I just want to say too that I think is a really important point to make is that you recommended 3 companies the previous time you were on the Money Talk show. You said Acme, Polaris, and ProTech.
Yeah.
If you look at these businesses, absolutely amazing performance from these companies. They're all different businesses as well. I mean, you got Acme, they make first aid kits and other staples like scissors, making a lot of money at it, paying a dividend. You've got Polaris that pays a nice dividend. That's a renewable power producer with great growth opportunities over the next several years. And then you have ProTech, which is a home healthcare company and benefiting from the home healthcare trend. So all these profitable businesses, and this is really what we're trying to communicate.
Yeah, I mean, when you look at the breadth of those businesses, just the 3 businesses from the disparate industries that they come from. I mean, that's, I think, what, I'm not trying to toot our horn, but that's what we bring to the table in terms of our research. 3 completely different companies, one listed in Canada, one doing business in the US, although listed in Canada, and then one doing business, all over the world, but, listed on the New York Stock Exchange. And just the similarity to all of them is great profitability and bought at reasonable prices, and returning money in terms of dividends on 2 of them to the shareholders as well, but tremendous growth in those businesses as well. And those are the type of businesses that we like to bring to our clients, and that's why when we go on a show like that, you briefly mention those companies and then revisit them. Usually it's not within 3 to 4 months. You want to revisit a year or 2 later, but over the 3 to 4 month period, these have done tremendously well, and we'll see how they continue to do going forward. But again, we say all of those businesses were bought significantly lower by our clients, and that's what we endeavor to do when we do that research. And and you talked about being able to dig deeper. That's what I do love about these seminars and the live webinars that we have coming up. When I do a hit like that on a radio program, you get to go for 30 seconds to a minute and a half on a topic, but we get to go for 2.5 hours and dig into some topics, and that's what we'll be doing there,
and then answer questions after.
Yeah, a 45-minute Q&A at the end, which is great. We answer any and all questions from the attendees there. We talk about building that simple 15 to 25 stock portfolio, get our market outlook, and we talk about hot topics at this event, give you a 4 to 6 stock starter portfolio. So I encourage you to come to that event. It's April, there's 2 of them, April 6th, 7 p.m. Pacific, 10 p.m. Eastern, and then April 13th, we make it a little easier for back east. It's 4 p.m. Pacific, 7 p.m. Eastern time on April 13th. The tickets are selling faster than ever. It's awesome to see. Every time we do one of these, we have more and more people going to them. So at some point, we're going to have to cut off the room size because we started to get too many people in there. But and that actually may happen this time. So I would encourage you to get your tickets ahead of time. The last thing I'll say about my appearance there, apparently I made one of my sisters, I brought her to tears with the appearance on Money Talks, and I wasn't intending to do that, but I told a story about a client of ours, a farmer out of Saskatchewan, where Brennan's from.
Represent.
And I'm not going to tell the story today. Maybe I'll save that for another episode because we've already went long on the intro here. But I should tell that story again on our podcast. But apparently I brought her to tears. It was more because of what we were able to do for that client with one recommendation and what he was able to achieve for his family. And I think we should really get into a couple of those stories in an upcoming episode, and we'll do that. I'm kind of tease that right now. Hopefully I don't bring everybody in the audience to tears. That's not my intention.
Are you sure it wasn't the Shawshank Redemption metaphor that brought it to tears?
That brings a smile to my face. Although when we're crawling through that river, right, of crap to find those 2 or 3 companies after looking at 3,000, the smell of stink from some of the companies that we look at that really shouldn't be in anybody's portfolio in Canada does bring me to tears. That's the
Ryan
only
likes
thing that
the
does.
blame it on the companies, the smell on the companies.
Yeah, it's weird because most of the time my office smells pretty good, but then Aaron walks through and I just
I don't know. I've been there a long time, so I think you should look for other sources. But
Well, that's
anyway.
because he's just been in Brennan's office and it just sticks to you, right? That once you go in there, that stink from Saskatchewan. All right, I'm done. I'm kidding.
Yeah, hey, careful what you say.
You guys smell great. Okay, does that make you feel better?
Yes.
You guys both smell great. All right,
You're
let's.
just kissing up to Brennan now because you know he's the judge of the stock debate.
I said you both smell great. Okay, but he gets the accolades too for smelling just wonderful. All right, let's look at Amazon. That is our it's going to be our case for case against debate. Amazon.com is still the name, AMZN on the NASDAQ. $3,055 is where it trades. Market cap is $1.53 trillion. They operate through three segments. It's called North America, International, and Amazon Web Services. The primary is to the two services. It's a e-retailing giant, and it is huge in the cloud, leader in the cloud through its Amazon Web Services. It also manufactures and sells electronic devices, Kindle, Fire tablets, Fire TVs, Ring, Echo, and other devices. Now, let's get into this. We've got a case for, I think we're going to start with a case against. We did a pre-flip on this one, a flip of the coin, and Aaron has the case against. Aaron, are you ready?
I'm ready, and I'm confident.
Are you ready, Brennan?
I am ready.
I'm confident I can bring in the W.
I'm ready.
Bring
Just
the W.
getting my.
How about you,
my
Brennan?
timer
Do you
here.
have faith in me?
He's not ready.
I have faith. I have faith.
He didn't say in you. He just says he has faith. You realize that, right?
Yes. Yeah.
Okay, well, let's
Okay.
start
So
here. Talk is cheap. Let's
Yep.
get things going.
3, 2, 1, go.
1. Amazon may be near peak earnings with uncertain growth. People have been forced to shop online during the pandemic, but as the economy opens, spending will shift away in the short term. Amazon's own Q1 guidance reflects the uncertainty with a very wide range of expected operating earnings, $3 billion to $6.5 billion, which is potentially below earnings from the same quarter of the previous year. 2, very high valuation at over 70 times earnings for Amazon. This compares to other great high growth FANG stocks, Facebook, Apple, Microsoft, and Google, that are trading at valuations in the 30 to 40 times range. 3, Amazon's leadership in cloud computing has been a key driver of growth, but this position is eroding. 3 years ago, Amazon owned 32% of the market. Competitor Microsoft owned 14%. Today, Amazon still owns only 32%, while Microsoft's share has grown to 20%. What happens to the valuation as they lose that leadership position? 4, long term, there's a good argument in favor of Amazon, but in the near term, uncertain growth, high valuation, and eroding. I think you know where I was going with that.
Yep. I think I know. Good job.
Yeah, that
Good
was
job.
well put together.
Very
But
well.
enough.
done.
unfortunately,
That's the
all in
question.
vain, right? That's what we're saying.
Honestly, I thought it was good, like just hearing Aaron's part. I thought it was going to be a lot easier. Don't want to put my bias in here already, but yeah, we will see what Ryan has to present me.
You did
All
just
right.
check your email for that e-transfer I just sent you right there, right? You did just check that,
Thanks
right?
for the- thanks for the advance.
All
Yep,
right.
yep.
That's how we get it done around here,
Appreciate
right?
it. Yep.
Good.
We're good. Okay, so are you ready, Ryan? I'll count you
I'm
in
ready.
here. 3, 2, 1, go.
First off, you want to own great growth businesses that lead. Amazon is that. Number 1, dominant e-retailer. Number 2, Amazon's Web Services, AWS, is dominant in cloud computing and enjoys margins that most other e-commerce competitors can only dream about. The growth will continue. The current growth is tremendous. Revenue has jumped 118% over the last 3 years, accelerating in 2022 to 38% from 2019, even at its size. Operating profit jumped 458% in the last 3 years and 58% in 2020 alone. Q4 didn't just beat analyst expectations, it demolished them. Revenue was up 44%, net income more than doubled. Amazon is actually not that expensive. Its forward PE is 64.4. Next year's is 46.3, and 3 years out, 30 times. That is around its growth rate going forward. That is growth at a reasonable price and a high quality name. It's off 11% from recent highs. It seems like a no-brainer. Time to add a premium name, growth name long term.
Well timed. Okay, so the ball is in my
no pressure
court
here,
now.
Brennan. No pressure, eh?
Yeah, like I said, I thought that it was going to be a little easier. Again, I think that in the long run, you can't really bet against Amazon, but Aaron did make a really good case. Earnings are peaking right now because of COVID. Trailing earnings, they are trading at a pretty high multiple, 70 times. That is, getting higher, but I have seen worse. and definitely higher than its comparables. But its market share is staying the same. As he was saying, Microsoft is increasing their market share, but at least Amazon's is staying the same and it's not decreasing. Now, in regards to Ryan's, like he said, I do think, looking forward, the stock isn't priced too unreasonable. I think it's 46 times 2 years out, he was saying. And just again, I don't think that I can bet against Amazon. So the short term, I agree with Aaron. Be careful, where you're purchasing that stock. But in the long run, I do think that the stock definitely can offer some growth at a reasonable price, even though it is a pricier name. But you're getting that premium stock for that premium valuation. So Ryan is the winner.
Still undefeated.
Congratulations.
I'll tell you, that one is really
undefeated?
tough. Oh, I'm undefeated.
Really?
Oh yeah. The
He would know. Hey, Aaron, he would know.
No, of course he would. But honestly, that is a tough one for like a value, and growth investor, because I agree in the short term, it's hard to pay those valuations, particularly when you could see a downtick in earnings, just like Aaron said. And I mean, it's curious because it's great because when we did our last analysis of the FANGs, we did that in the fall. We came out with one of the companies that the top company. I'm not going to say which it was today because it's an active buy on our list, but it is a company that trades at lower valuations. Is one of the FANGs, is accelerating earnings, whereas Amazon got a definite bump. I mean, there's a tremendous growth company. They got a bump from everybody staying at home and everybody going online. Now, that's probably part of it's probably sustainable going forward, but in the near term, I'm not sure if you're going to see everybody, ordering online that was forced to order online, in the Q1, Q2 period of last year. So it's tough comparables year over year, and Amazon is guided towards that. So in the near term, there's another of the FANGs out there that we believe will benefit from the reopening and trades at lower valuations. So and it has actually since the fall tremendously outperformed Amazon. So it's good to see that when you make those research conclusions, they are working out.
Yeah, that recommendation's done very well.
Yeah, and you know that I like to bash Brennan as much as the next guy or girl.
Of course.
But I can't really disagree with your statement there, Brennan, and that's kind of the way that I look at Amazon as well. I've said many times in the past, I would never argue with anybody who is going to buy Amazon. The eroding leadership of the cloud to me is a concern. I don't hear it really talked about that much, but cloud just as a market is growing. So there's going to be growth
itself,
in that business.
Yeah.
E-commerce is going to continue to grow. Yeah. Maybe they're gonna see a bit of a downtick short term after the pandemic. Maybe not even, but long term, that's the way things are heading. So if you're looking 5 years out, I wouldn't argue with somebody.
You may have lost that one on the flip of the coin more than anything, right? Like it's hard because it's really it's hard to bet against if you're looking 2 to 5 years out. I mean, there may be
I could.
Yeah, you did well. There may be there's always, for us, it's always where else could your dollars go? And looking at one of the FANGs, there's probably one that we would prefer. It's not that we're saying Amazon's not a company to buy over the long term. There's another name we might prefer, or two, in that segment. Yeah. Okay, now we're going to look at our Your Stock, Our Take segment. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Question came in, I believe, from Jazzmeat via YouTube on Enthusiast Gaming Holdings Inc. Brennan, you have that tasked in front of you.
Yes, this one came in from Jazzmeat via YouTube, and I'd also like to give one of our clients a shout out, Peter. I know that Peter has held this stock for a while, not based on our recommendation, but he's done well with it. Anyways, let's take a look at Eglx here. So Enthusiast Gaming, Eglx on the TSX, currently trading at a price of $8.83 and has a market cap of about $1 billion. So Enthusiast's principal business activities are comprised of media and content, as well as entertainment and eSports. So its divisions are made up of, number one, digital media platform, where it includes 100 plus gaming related websites and 1,000 YouTube channels, where essentially they're just advertising on. Number two, their eSports division, which they call Luminosity Gaming, which they're a global eSports franchise that consists of 7 professional eSports teams under ownership and management. And then number three, they also have their event business, where they own and operate Canada's largest gaming expo. But of course, that's taken a recent hit here just because of there's no in-person events. But I do believe that they've shifted online. So now looking at a few key points here. Now, the company has been making some pretty impressive partnerships. One has been with TikTok, where TikTok is going to use Enthusiast Gaming's platform to essentially market itself, as well as they recently made a deal with Samsung, where Samsung will also be sponsoring, I believe, some of the gamers. Now, looking at some of the company's acquisitions and adding some fan communities to their platform, on in March of this year, they acquired Valuations, which is the owner of icyveins.com, which is one of the largest independent Activision Blizzard fan communities, for about $8.3 million US in cash and stock. And then in August of 2020, last year, they also announced the acquisition of Omnia Media Inc. And Enthusiast Gaming acquired 100% of the issued and outstanding shares of Omnia for, I believe it was, it says here, 18.25 million common shares, 11 million in cash, as well as vendor take-back note with 5.75 million face value. So the thing here, just looking quickly at these acquisitions, they say how much they're paying for the acquisitions, but we really don't have much color on, the cash flow or the revenue coming from them. So it's very hard to, basically see if these acquisitions are accretive. Now, as well, the company, I will just add this, the company is planning to list on the NASDAQ in the future. So looking at the company's recent financial results for Q4 of 2020, revenue was $42.5 million, up 361% from the same quarter last year. Net loss for the quarter was $6.9 million compared to a loss of $60 million for the same quarter last year. 12 trailing month adjusted EBITDA was a loss of about $11 million. And on December 31st, 2020, the balance sheet was showing quite a bit of leverage with net debt of $31 million. But I should include that in 2021, the company has since converted $9 million of its debt into shares, as well as it raised an additional net proceeds from a bought deal offering of $50 million. So I believe that now the company should have a net cash position. And then also just looking at a price to sales valuation, after they acquired Omnia recently, they provided a pro forma revenue run rate of about $127.6 million. So that provides the company with a forward price to sales multiple for the 2021 fiscal year at approximately 8 times, which I would say is getting a little bit on the pricier side. So to conclude on Enthusiast here, for a company that isn't currently profitable, it is exerting some favorable characteristics, such as its net losses decreasing as the company's revenue is growing. Plus, management has shown the desire to scale quite aggressively. And, I've said this quite a few times on the podcast. Being a gamer myself, I see the direction of the company as being generally positive. And one critique, though, is that I do wish the company would break out the financial data on the target companies it is acquiring through acquisition so that I could really assess if the company's acquisition growth strategy is accretive. Now, although the company is not profitable, it is slowly working towards profit, which is good. And after its most recent equity raise and debt conversion, the company has a reasonably healthy balance sheet with a net cash balance. But Eglx does trade at 8 times forward revenue, which I would argue is quite pricey. So all in all, exciting space, working toward profit and pricey valuation. So I would argue that its current level, it does not meet, or it does not offer growth at a reasonable price, and we would stay on the sidelines. Now, again, just to reiterate from our discussion on the podcast a few weeks ago, this does not mean that I am betting against EGLX. I am simply saying that for our growth at a reasonable price strategy, the price that I am paying right now doesn't provide me enough margin of safety to the downside and confidence that the stock should continue to run higher in the near and long term.
Yeah, no, it's a good summary. I think it's in an exciting sector, and there's tremendous revenue growth there. I mean, it's backed by a family with a ton of money as well. But I mean, and there's, if you want participation in that sector, perhaps it's an option. But again, it just doesn't fit into our criteria because there's no profitability at current price. And if you look like what we need. And it's certainly in a hot sector right now. And why I say we require profitability, I can give past examples. If you have profitability in a company, the gains in that stock and what you do based on those gains, whether you buy, hold, and sell as the stock goes up, becomes more certain if it's backed by profits and cash flow. Now, we've talked a number of times about other companies from hot sectors on this podcast over the past year. Sono Nanotech comes to mind. Is a COVID test provider. It flew up from around under $1 to $14 at one point. The stock is cratered to $1.82 in that range. So anybody buying in the 3, 4, 5, 6, 7, 8, 10, all the way up to $14 range has lost a significant portion of their capital. Well, the company has never had never posted profitability, never really posted any revenues. So it's just backed by nothing. It's a house of cards. It collapses. The share price has collapsed. There's companies like Xebec Absorption, which we like the business overall, and there is tremendous revenue growth there. But we saw, and they're in a hot sector, in a segment, the stock ran up from the dollar range from above $12. But this, and like we said, the company actually had great revenue growth and potential, but it missed estimates. Posted losses, it's posting losses, and the stock has been crushed from where it hit the $12 range. It trades around $4, I believe, in that range right now. That is because there's just no underlying profitability in the business right now, and when you don't have that, you don't have any margin of safety in the business, as opposed to companies that we look at that continue to post profitability over time. The Expels of the world, the Boyds, the Sangomas, the Enghouse, the Protec, the Trulieve. If you look up charts on these businesses, they continue to go up over time, and it's not in a straight line, but it's going up jaggedly. I'm doing a jagged chart going up with my hand right now. You can't really see, obviously, but that's what they're doing over time. It makes really great podcasting, right? I'm explaining what I'm doing, but what we see there is all those companies, Expel, Boyd, Sangoma, Enghouse, Protec, Trulieve, posted huge share price gains as well, but the gains have been sustainable and they have built on themselves as they were backed by cash flow. Now, for these businesses, you can hold long term. For me, this is the difference between investing versus speculating in these businesses. So hopefully that makes sense.
And I'd like to add too, so EGLX, they're currently not profitable. They're probably going to have to raise more money in the future. And the thing is so they're raising money through equity raises and they're making acquisitions, but yet we can't really value, or as far as my quick analysis this morning on EGLX, I can't value if these acquisitions are being accretive to the overall business. So that there's another layer where it's a little bit more uncertainty, which keeps me on the sidelines personally.
And I mean, EGLX is not Sono Nanotech. It's not a company with zero revenues, obviously zero profitability. It's more akin to Xebec in terms of, at least there is tremendous growth there. It's in a hot segment. They have not hit profitability. At one point, Xebec did. But, it's a company that has continued potential. We understand, what they're trying to do, acquiring that user base that they can use to, sell to. It does seem to make sense from that perspective. But, it's one thing to do that. I think their properties attract over 300 million gamers via their websites, YouTube channels, eSports, and other organized events. But to be able to then execute on monetizing that, bring it to profitability over time is another endeavor altogether. So there's execution risk in this business. And when you haven't proven out that you could do that in terms of profitability, you're betting on management, you're betting on the sector going forward. If you want to do that, that's fine. We love to bet on management teams that have already delivered on that. You can buy at reasonable prices and have the same upside over time as an enthusiast may have. So hopefully that makes sense. I think that's going to, any ending comments you have, Aaron, or are you good?
I think you guys covered it all. I mean, it really just, it comes down to me to validating the business model. And I understand why people invest in companies that aren't yet profitable. At least this company does have good, significant revenue. It's growing its revenue quite substantially. So that's a great sign. But for me, it ultimately comes down to the profitability. Now, if I was very assured that this company would enter profitability in the next year or two, it would make me more interested.
For sure.
But there are a lot of companies that grow their revenue, but as they're doing that, they're also growing their losses and growing their cash burn as well. They never hit profitability. And when there's so much excitement in a stock that isn't making money, there's just too many good companies out there that are making money, that are growing, that have businesses that I feel I fully understand, or at least have a very good understanding of. There are companies like that to invest in where you can make amazing returns. So I don't personally see a need to speculate on companies that haven't validated their business model through profitability. If people want to do that, go ahead. Just understand what you're doing. Understand those risks. Every company in your portfolio should not be like that. And that would be a mistake.
And that's the key point I think you make at the end. Enthusiast unto itself may do well over time. That may do, but if you create that, it's about for us creating that portfolio too. And if those 15 to 25 stocks that you own fit the profile of enthusiasts in terms of, there's tremendous revenue growth, but they're not profitable. So you're really speculating on what they can do in the future to monetize their platform. If all 15 or all 25 companies have that profile, it's far too much risk in your portfolio. When you can have companies that have already monetized what they're doing, have already produced cash flow, have similar upside, and trade at more reasonable valuations, proven out their model. That is what we want 15 to 25 of those type of companies, because it is hard enough when you have that type of company as a profile to have enough companies make a difference in your portfolio to beat the market over the long term. But when you do it the other way, you're setting your portfolio up for disaster over the long term. It could be one of a couple companies in your portfolio. If it's fitting the profile of all 15 to 25 in your portfolio, you're setting yourself up for disappointment over the long term. Okay, well, that's going to end our show for this week. Keep rating us, reviewing us on iTunes. We love the feedback. Keep your questions coming in to our Your Stock, Our Take, case for, case against. Ask us anything in the markets as well. And get your tickets to our upcoming seminars, April 6th and April 13th. We'd love to see you there. And again, we're going to wish you profitable investing.
Thanks, Ryan. And I'll just add, whatever platform you're on, hit the like button, hit the share button, leave a comment, positive or negative. That's how we get the feedback. That's how we know that we're putting out content that people like. So we appreciate listening, profitable investing, and we'll talk to you next week.
Thanks, everyone.